In 2021, a report dropped that made a lot of Americans do a double take at their paychecks. Jeff Bezos, one of the richest guys on the planet, paid zero in federal income taxes in 2007 and 2011. Elon Musk, zero in 2018. George Soros, zero for multiple years. And before you jump to offshore accounts or shady backroom stuff, pump the brakes. This was legal, by the book, signed, stamped, approved. So how does someone worth tens or hundreds of billions end up paying less income tax percentage-wise than a public school teacher? It's not hustle, it's not luck, it's structure. It's a strategy quietly known as buy, borrow, die. And once you see how it works, you can't unsee it. UL realize the tax system isn't just about how much you make, it's about how you make it. Here's the part most people miss. If you get rich the normal way, meaning you earn a paycheck, you re-on the hook immediately. You make money, Uncle Sam takes his cut. Simple. If you invest what's left and your investments grow, cool. But the second you sell, boom, capital gains tax, another slice gone. Now imagine you're a founder. You started a company in your garage. Fast forward 20 years and that company is worth $10 billion. On paper, you just made $10 billion.
Ow.
But here's the catch. You don't actually have $10 billion in cash. You have stock. And if you sell even a chunk of it to buy a jet, a mansion, or just live large, you trigger a massive tax bill. So what do the ultra-wealthy do? They don't sell. They sit tight. They let it ride. That's step one. Buy appreciating assets and hold them like your life depends on it. Stocks, real estate, private businesses, art, anything that tends to go up over time. Here, the golden rule. The IRS can tax gains you haven't realized. If you buy stock at $10 and it rockets to $1,000, that $990 gain is real, but only on paper. Until you sell, the tax bill doesn't show up. For billionaires, those paper gains aren't pocket change. We're talking billions, tens of billions, just sitting there untouched. But now you're probably thinking, okay, cool. But how do they actually spend money if they never sell? That's where things get wild. Step 2, borrow. Let us say you're sitting on $10 billion worth of stock in a company like Tesla. You walk into a major bank and say, I'd like a loan. My shares are the collateral. The bank looks at your balance sheet and says, say less. They'll happily lend you hundreds of millions, sometimes billions, at super low interest rates. Why? Because your stock is worth way more than the loan. You're basically the safest bet in the room. And here's the kicker. Loans are not income. You can borrow $500 million, have it wired straight into your account. Buy houses, yachts, private jets, whatever you into, and the IRS doesn't treat that as taxable income, zero income tax. Meanwhile, your stock keeps growing. If it's compounding at 8 or 10% and your loan interest is 2%, you're still coming out ahead. You're spending borrowed money, your assets keep climbing, and you haven't sold a single share. That's how someone like Larry Ellison could borrow against his Oracle shares while living like a Bond villain, yachts, islands, the whole 9 yards. And yes, when Elon Musk bought Twitter, a huge chunk of that deal involved borrowing against his stock, no selling. No capital gains tax triggered. Now you might be thinking, cool story, but loans have to get paid back, right? You can't just borrow forever. Technically, yeah. But here's the final move. Die. Sounds dark, but stay with me. When a wealthy person passes away, their assets go to their heirs. Under current US tax law, those assets get what's called a stepped-up basis. In plain English, the tax clock resets. Let's say someone bought $1 million worth of stock decades ago, and now it's worth $50 billion. If they sold it while alive, they'd owe capital gains tax on almost $49.999 billion. But if they die holding it, the cost basis resets to the current market value, so the heirs inherit it at $50 billion. All that built-up gain, wiped clean for tax purposes. They can sell it the next day and owe little to nothing in capital gains. The loans get settled by the estate, the wealth transfers. The tax on decades of growth, it's often never paid. Buy, borrow, die. And this isn't some Bacali loophole someone hacked together. It's written into the US tax code. In 2021, an investigation by ProPublica looked at the tax returns of America's 25 wealthiest individuals. Between 2014 and 2018, their combined net worth grew by $401 billion. During that same period, they paid $13.6 billion in federal income taxes. Do the math. That's about 3.4%. Meanwhile, a teacher making $45,000 a year might be paying an effective federal rate in the teens. A nurse, a firefighter, an engineer, regular people grinding every week. This isn't about billionaires being villains in a comic book. It's about how the rules treat wages versus wealth. Wages get taxed when you earn them. Wealth, if structured the right way, can grow for decades without triggering a tax event. Now, to be fair, there's real debate here. Critics say this setup lets massive fortunes snowball across generations, while everyday workers shoulder a bigger relative burden. Defenders argue that taxing unrealized gains could force founders to dump shares, potentially rocking companies and slowing economic growth. Both sides have points. But here's what's not up for debate. The rulebook isn't the same for everyone. Most people are playing checkers with their paycheck. The ultra-wealthy are playing chess with assets, leverage, and estate law. And no, most of us aren't going to replicate buy, borrow, die at billionaire scale. You're probably not walking into a bank with $10 billion in collateral anytime soon. But understanding how this game works changes how you see money, taxes, and wealth building in America. Because the wealthy don't opt out of the system, you just know how to use it differently. And the first step to playing smarter at any level is knowing the rules.